Hi everybody, I'm Steve McDonald and this is the IDE Midweek Market Update. Well, first up, the stock market. We're in a range-bound market. That means we're locked between about 9,800 to about 10,500. And we're not going anywhere until we see the full correction of 10%. Now, we got about a 6% drop before it slowed to our present level, but we need the rest of the correction to shake out all the bearish sentiment. And there's bearish sentiment in this market. Now, I filmed this on Tuesday afternoon. I know the market's getting whacked a little, but there's more to come. And if you need proof, look at the earnings season so far this time around. 78% of companies exceeded estimates, and we sold off. The market sold off despite all that good news. All indications are we have turned the corner on this recession, and the market still sold off. This market wants to sell off, and it will. Look for it and prepare for it. For the sound profit readers out there, look for us to increase our positions when it happens. Our fractional buy-in and stop-loss system has worked better than I could have hoped for. As I say, plan on this market going down and you'll never be disappointed. Housing, the Case-Shiller Housing Index showed improvement in its 10 and 20 city measure over 2009. The biggest gainers, and we actually had markets going up in price, were San Francisco, Boston, Washington, D.C., Denver, and New York. And we saw generally improving numbers for the country as a whole, except for, as you might expect, Nevada and Florida. Consumer confidence came in at a 10-month low. That's not what we were hoping for, but nobody's really surprised. The job numbers are probably pushing that down. Toyota, this stinks more every day. An inside memo or email, I don't think anybody calls memos anymore, but this inside email bragged about beating a $100 million fix to their electronic fuel control by giving out 55,000 floor mats. People continued to die in their cars, but they had new floor mats. This will be the usual grandstanding show in Congress when we have Mr. Toyota testifying. Not much will come out of it, but the Toyota brand will have serious problems going forward. The crack in their veneer is there, and it will not go away. Their president, Mr. Toyoda, spelled with a D, doesn't seem to be helping the situation with his comments about not knowing how people use their cars and referring to broken cars rather than dead customers. What happened to the story about the 4 congressmen whose families had business dealings with Toyota and are thought to be the ones who arranged for all of the Toyota's easy fixes to slide through the National Highway Transportation and Safety Board since 2003-2004. That's how long this has been going on. This one got lost and only made it to the news once that I know of. That's just lovely. Toyota is still a long-term short. Commodities. Here's an interesting story. Billiton, BHP Billiton, is proposing raising coke and coal prices for Japan by 55%. That's a lot of money. Now, is this the first of many commodity cost increases we've been talking about in IDE that have to happen as the worldwide economy recovers? Yes, and it's just the beginning. One way to play this is obvious, the coal and coke, iron ore, etc., commodity trades. But here's something I talked about last summer and is another way to play this move. No recovery occurs without steel. I recommended U.S. Steel last June in Sound Profits, and we already bought it and sold it at a big profit, and we've already bought it back when it dropped during the sell-off last month, after the most recent sell-off. Now, coke and coal produce steel. It's an early sign that the recovery is underway, and especially in Japan. Think steel. Now, I can't remember who recommended it last year, but Japan is selling at 25-year lows. This is worth a look. Take a look at an ETF for Japan. There's one out there. Just search ETF Japan. It'll come up. Now, last summer, I also recommended AKS Steel. Take a look at it. It has a way to get back to the top. This is going to be a good play. Now, oil is going to 95 this year. I know, as I said, we filmed this on Tuesday afternoons. Oil's getting smacked today. But the stories of shortages and problems in the pipelines are showing up already. Add to that the nuclear threat with Iranian nuclear devices and their new guided missile cruiser. It doesn't take a genius to add 1 and 1 to find out what they're going to use it for. And we have a real mess forming, and oil will go crazy. So get in on this play. Another interesting move this week is the new attention to the Chinese currency, the yuan. And it's not getting it here, but it is getting it abroad. The only place I hear talked about it is between 4 o'clock, believe it or not, I get up that early, between about 4 a.m. and 6 a.m. when they're doing the European and Asian wrap-up on CNBC. Now, the Chinese have kept their currency very low to benefit their exports, but it is approaching a point where it will hurt their productivity too. They must buy all their imports, commodities, with an artificially low currency, which means they pay more for them in real cost. Look for them to allow the yuan to run up to help lower the cost of goods coming into China. It has to happen. Now, while we're on China, there was a lot made of China selling a lot of our 2-year Treasury bills recently. This is really of no consequence. This was nothing more than China getting back to normal levels of how much of our debt they want to hold. They are simply unwinding the huge amount they bought after the Lehman Brothers debacle last year, or the year before. Now, the U.S. debt is still the most sought after in the world and will be for some time. Now, what this government does in the next few years concerning the debt and deficit will determine how long that situation will continue. But for now, it's a non-event for them selling our treasuries. Finally, the governor of the Bank of England seems to be one of the few people in the world who understands macroeconomics. He said Monday in a presentation in the UK, if you raise taxes now in this environment, it not only will slow economic development, but it will fuel inflation. Doesn't take a genius to understand that. Now, with that in mind, this week's Slap in the Face award goes to our president, Mr. Obama. 65% of the American people are opposed to his form of health care reform. So he finds another way to get around the congressional process and push it through by changing the rules. Why? Because we don't know what we want and we don't know what's good for us. Come on, Mr. President, you've got to be joking. How in the name of God are we supposed to insure another 30 million people? And remember, this insurance, this medical coverage is going to be virtually free to them without increasing taxes and increasing our own health care costs. It's bad enough this guy doesn't have the experience to realize a one-size-fits-all plan for 300 million people is a bad idea. He doesn't seem to understand the most basic macroeconomic concepts either. Raising taxes fuels inflation and slows growth. Believe me, Mr. President, it does. No matter how much you maneuver to get your idea through, it's bad for us at this time. Now, I'm beginning to wonder, is this about his agenda and the success of his presidency, or what's best for this country? This is scary, but it'll be a huge boost for healthcare stocks. Plan on it. So we might as well make some money on it. I would start looking very carefully at healthcare. Now is not the time for this type of expense, and his approach is a reflection of his complete lack of life experience outside of universities or Chicago politics. This is insane, and our only hope is that enough senators and congressmen will oppose it to get us to the midterm elections when we can get some balance back into this country. That's about it for this week. We'll see you next Wednesday. For everybody here at IDE, I'm Steve McDonald. Thanks for being a part of us.